Welcome, everyone, to Health Further without Marcus. He is off vacationing with his wife in an undisclosed location, and so I'm trying to carry the ball without him. Excited to have Grant Chamberlain of Ziegler here. Grant, thanks for doing this with me and filling in. Appreciate it.
No, I'm really excited about this. Thank you.
So we have had a ton of growth over the last several episodes. And so I think it makes sense just to sort of quickly touch on Health Further, why I started it, and then why I wanted to have you on as a guest here this week with Marcus out of town. I think you may know this, but a lot of listeners are new. And so Marcus and I, been VCs for a long time. We were really searching for a podcast that would help us understand the VC market in healthcare in the context of the overall kind of incumbent industry policy, what the federal government is doing, and of course really drives a lot in healthcare, and capital markets, starting with venture, but then IPO markets, M&A markets, and large public companies, all the way up to the Federal Reserve and macroeconomics. And we couldn't find that. We were both like piecing together various different podcasts, but of course they don't give the overall context. And the point was really just to learn for ourselves. And so we started this show, I think it was 15 weeks ago, maybe 14 weeks ago. And it's been really fun for me. I've sort of been forced to learn, get my act together to talk to an expert like you. But surprisingly, the listeners have really taken off. So we've had incredible growth. I think the key is that all these things all intertwine together and they affect each other. And I'm excited to have Ziegler on because we've had a couple other guests. Our first guest was Emily Evans, who's really a deep expert in policy. Then we have David 2 weeks ago when I was out talking about the healthcare industry. We had an innovator on, but we haven't had a capital markets expert as a guest. So Grant, you are the first, you're our best by far, head and shoulders above any other capital markets experts we've had. Super excited to have you on. Thanks for doing this.
No, absolutely. Thank you. And I need to apologize at first because I listened to Dave Johnson's interview before, and I'm going to give it a fairly obnoxiously long introduction, but it will tie thematically to everything we're going to be going through here.
Yeah, that's perfect. I want you to talk about your personal background and then also how Ziegler fits in, because Ziegler, similar to the company Marcus and I started, really has a long history in the incumbent industry, but now has done a lot of banking and innovation. So, yes, talk about yourself and Ziegler.
No, absolutely, and by definition, it's going to loop right to Ziegler as part of that transition.
Okay,
so
great.
I'm going to touch on. You're going to hear sort of three themes that I'll transition through from the beginning end of my pathway, my career, and initially you'll understand how they tie together when I'm done. House calls that physicians used to do, turnarounds and workouts, and innovation and disruption. My father was a MD. He's now 96, still alive. He was an internist in Milwaukee. He was at the top of his career. He was chief of staff of one of the biggest hospitals in Milwaukee. He was practicing in what I sort of continue to reverse as the glory days of medicine. I watched him in the 70s as one of the most respected professions, the medicine was at that point in time. And interestingly, he did, 2 to 3 house calls a week on his way home, all the time. I used to watch this. My friends and families who he was the doctor to, many of them would always say my father stopped by. I was like, well, that's, it was sort of a cool thing. I never really thought about it.
What was his specialty?
He was an internal medicine. Okay, he was an internal medicine specialist. He was incredible. He graduated number 1 out of Marquette Medical School. He was on he was on the board of the Medical College of Wisconsin. So he was a revered physician at the time. He was actually the doctor for Miller Brewery, for the Bucks, the Brewers. Bob Uecker was a patient of his.
Oh,
so I was watching him.
That time frame, I agree. That time frame, that's 67 is when HCIT started, but the 70s were really
you're getting to my punchline here.
Oh yeah.
So
Okay. Sorry.
from age 10 to 20, without question, there was no question in my mind I was going to be a doctor. But, I was from 0 to 10, I was going to be an NBA basketball player. But from 10 to 20,
Yeah.
I was going to be a doctor. And because I watched the profession, I watched the sort of the glory of what he was doing. I also started when I went to University of Wisconsin pre-med. I did organic chem, cellular biology, did all of that. But interestingly, I had a spinal fusion done between my sophomore and junior year in college, and
Wow.
at the same time I had begun to be I was doing an internship at Blunt Ellis and Lowy, which was a broker dealer in Milwaukee, and it was when the markets were exploding, and I was watching. I actually ran on the
What
floor.
year is this?
This
What
was
year were you?
in 86 and 87 and 88.
Okay.
I did the
Before
3
Black
years.
Friday, 87 or whatever.
Yeah, bingo. So you're cheating. You're getting my punchline.
Sorry. Yes. Okay.
No, I love it. But that's so you're getting the punchline here. So what I was watching though, as I went in at that time, I had spinal fusion. I was in the hospital for a fairly long period of time.
Yeah, that's a serious operation for a college kid.
Yes, but I was starting to see both my father's business and his aptitude and desire for medicine, as well as all these young physicians, because managed care was just becoming, HMOs and managed care was just entering the market at that time. And I was watching him, his practice, and then I was watching him talking to these young doctors while I was in the hospital. And I said, they're really kind of miserable. By definition, was watching the transition from it becoming a profession to a business. Healthcare was transitioning to become a business. And I was at this broker dealer, and I approached my father during the summer before my junior year. I said, Dad, I think I'm going to leave pre-med and go into the business school. And as you can imagine, he was a bit crushed. But I said, I see all these guys working their tail off, and they're really not happy. It wasn't about money because, at that time, internists still today.
Still doing okay. Yeah.
Still doing fine. But I said, to spend that much time to be in prison until I'm 30 and walk out and be unhappy and be a business person is what I was watching you with the glory of what your practice was. So I stepped away from it. And I went into the business school at University of Wisconsin. My first job out of college was at GE Capital in their corporate finance group, and GE Capital's corporate finance group.
Incredible training platform.
In the late 80s, the corporate finance group was the single biggest provider of debt to the LBO and the MBO craze. They were funding all of the fund money going into the space. And we're going to go back sort of thematically very well.
And they really did a good job of training new college grads. I mean, they were
exactly
excellent.
right. GE was at that time under Welch, all aspects of it. I tell people all the time, I got my MBA at GE, whether it was at GE Capital, the corporate finance group, and the financial management program. It was great learning grounds. But it was the uniqueness of the sort of where that period is GE was pounding capital into the marketplace during that time. In all honesty, very similar to today. This is where we're going to come full circle at very inflated valuations with way too much debt going into these companies. And so I was at the front end, an auditor and analyst into the money going into the system. And then you brought Black Friday. Yeah. All of a sudden, the market flipped on its head. And I was doing exceedingly well. I was one of 50 analysts. I had won Analyst of the Year a couple of years in a row. And they asked me to join the workout and turnaround team because in a period of 1 year, GE, that was
all the work was in feeding money in, and then the beauty of GE is then the work flips. Yeah,
it is, and it was a wonderful. I'll tell people, all my analysts and people I talked to about what was the more formative years of my career, workouts and turnarounds, hands down. You learn everything about a company and an industry. What are the levers that drive whether success or failure, and how can you step out of a point of distress. So I worked in the workout group at GE Capital's corporate finance group, and interestingly, and this is where we're going to get to healthcare, I got a call from GE Medical Systems because I had been doing very well early in that stage of my career. And GE Medical Systems in the early 90s had essentially created an entire industry in the imaging center space. They were financing, they were pouring capital into, it created essentially 6 or 7 different public companies by dumping cash into driving CTs and MRIs, mobile and fixed site imaging centers.
And they also sold the hardware. I mean, the beauty of GE is they sold the hardware, they financed it,
they massively. So GE was far and away the leader in the space. And in a period of about 6 months, the imaging industry crashed because the reimbursement for in
HMOs, like HMOs came out and tried to cut it.
1990, 91. It was very simple. Reimbursement for an MRI went from $2,500 down to about $1,100 almost overnight, because the payers said, wait a second, we've got way too much equipment out there. The utilization was going through the roof. They said, no, we got to slow this down. And so all of a sudden, GE had over $1 billion investment into the space. And they called me and says, Grant, can you help us work out of this? And actually, from 91 to 95, I went to GE Medical Systems. And I helped them turn around and I actually kept all the parties out of bankruptcy, which was wonderful.
Yeah.
But I used every lever inside of GE and these companies.
And a lot of negotiation and horse trading and debates. Yeah.
And a lot of tools to use at GE, between whether it's service, equipment, upgrades, and otherwise, to sort of keep these companies healthy. Because I told GE, they can't let these companies go bankrupt, because if you have all this hardware hit the street, it would be a disaster. But that was sort of a wonderful formative educational period. And it was really where I learned some of the foundational attributes of where healthcare was going. And still GE at that time even was at the beginning stages of their revenue cycle, EMR efforts, and bringing best practices to their clients. Well, interestingly, I thought I was going to have a GE meatball tattooed to me for the rest of my life, as everyone was doing very well. And at that time, when Welch was there, the stock was splitting every 3 years. So the company was doing exceedingly well, and I had a fair amount of
maybe the best company in the world in
no question.
Early 90s. Yeah,
unquestionably it was a great learning experience, and again, great training experts that they would throw at you all the time. But interestingly, I got a call from my boss, both the guy who knew at GE Capital, and I joined at GE Medical Systems, had left GE to join an early stage middle market investment group called Shattuck Hammett Partners. And Shattuck Hammett Partners was really unique because they were sort of similar to Ziegler at that time, at the forefront of hospital financing, hospital bond financing. So they had Sharp, Mayo, Scripps, laundry list of some of the best brand name health systems that they were doing the bond financing for. And
with Shattuck Hammett and Ziegler, maybe a couple others, there only are 3 or 4 that really do a significant number of those hospitals.
That's right. And so, but interestingly, so he called me and he said, Grant, Shattuck Hammett Partners needs you. He said, they need a corporate banker who actually understands where the evolution of where imaging centers, surgery centers, physician practice management, because all these health systems were trying to figure out the next generation of where they were heading. So I had zero expectation that I was going to go in investment banking. I actually didn't even truly know what investment banking was, other than capital formation and M&A. And I flew out. I told my wife I was flying out to New York to visit.
With them. Yeah.
And I ended up going there, and it became early on in my career, started to do deals, and I took the job, moved my wife to New York City, and spent 4 years there.
From Milwaukee.
From Milwaukee.
That's quite a change. Was she okay with that? Was she excited or not?
It was an adventure. It was.
Yeah.
Well, she did it, but I will tell you.
Right,
4 years later, I came back. But it was an interesting time because it started to create the formation of sort of where we're going to go as part of this discussion now, of where digital health and telehealth become sort of a fabric of my current practice. But I did a number of deals in the surgery center space. The first deal I did when I left was I resolved my last problem children I had at medical systems, which were two imaging centers and mobile imaging companies that were public, and squished them together, got GE to take a 48% position in converting their debt to equity, and did a poof transaction with them to create Insight Health Services. I actually joined the board in my early Thursday, was the finance committee chair, and we brought the Carlyle Group in and ultimately sold to J.W. Childs and took a $5 stock and sold it at 18. And it was a wonderful transition, but it gave me a wonderful lens into the space. But as part of that time, I started to do deals because Shattuck Hammond really didn't have corporate bankers at the time, except myself and a couple others. But I did imaging center deals, surgery center deals. But I really started to do, I probably did as many practice management deals to Ficor, Med Partners, FPA as almost any banker.
Yeah.
And about 4 years later, unwound them all.
So just connecting our stories, Ficor was a big, messy birch where I learned venture. Ficor was a big, messy birch success, paid a lot of banking fees, bought up hundreds, maybe thousands of practice groups. But then it all got reversed.
Reversed.
The other direction.
But it taught me a handful of things. And actually, the thesis of Med Partners and Vicor wasn't wrong. It was just they didn't have the tool sets yet to manage risk, because the whole premise of what Med Partners wanted to be was create tools and technology to enable physicians to take risk, and the systems weren't there yet. Now, so I did a lot of deals, and I did a number of deals in the healthcare IT space as well early on, and a lot of them in the content space. And this is because
that was the internet. I mean,
the beginning.
The beginning of the internet. Yeah.
We're going to get this. So really, but part of that, where this is going to go, that's really relevant is I started to do a bunch of deals in the content and the evidence-based medicine space, because I realized the tools, technologies that were lacking in the practice management space was, how do we bring things that can help people manage risk? So I sold e-medicine to WebMD. And then I did the Zincs transaction. The Zincs transaction, if you don't know, was spun out of Cedars-Sinai. It now resides inside of Hearst. But Dr. Scott Weingart was I still say, the godfather of evidence-based medicine. And the four leaders of that group today are four of the leading principals in healthcare broadly in the marketplace. Josh Hoffman is at Grail. Dr. David Rue is the chief medical officer of Microsoft. Greg Dorn still is the president of Hearst Health. And Hearst Health is Zinc's first data bank, and all of the attributes. They are the one, but they were really leaders. But what I saw at that time was that we needed to find a place for trusted content, and trusted content. Zinc's was really deeply seated evidence-based medicine content that brought into the space. So that was a first foray into me. And then my timeline in the practice management space, all the lessons learned I got from the practice management space brought me to oncology. I started to do a couple deals in the practice management space of oncology, and I came to realize that one of the all the attributes that were thought to have brought into practice management, whether they're single specialty, pathology, imaging, or otherwise, oncology is the perfect wet lab for what a practice management is, whether it is, drug purchasing, equipment purchasing, but more importantly, managing risk today through oncology care management, but honestly, stepping into clinical trials. Community-based practices can never compete with academic medical centers unless you have a management company. So since then, I took all the lessons learned from the 90s, and I've done over 25 deals in the oncology practice management space. Honestly, most of them to U.S. Oncology, but I was the banker that was part of the formation of U.S. Oncology between AOR and PRN. But a lot of those themes really sort of build to where we're going into telehealth and digital health, which is, those are, how do you manage and navigate workforce more efficiently? How do you give them the tools and technology to navigate the flow of content? And there's no place that's needed more than oncology, because it's just such an incredibly complex set of solutions.
It's complex, it's life and death, and it changes a lot.
It does. It does. Yeah. So from there, I got a call while I was working in the digital health space early on. I got a call from a company in Texas called Airstrip. And Airstrip was still today, to me, one of the best single use cases and representations of what digital health and telehealth is, which
that was the first big success in digital health.
That's what put me on the map, because during that process, at that time, so a very simple use case for high risk pregnancies, on a BlackBerry phone at the time when we started the process, you could see mother's heartbeat, baby's heartbeat, contraction patterns, real time transferred to a BlackBerry phone. So when a mother and nurse and OB weren't proximate to each other, she could communicate with them and say, when mother was in distress, say, one, get her into surgery, I'll be right there, or don't worry about her, that's a pattern I've seen before, it's fine. Yep. Wonderful, simple use case.
Pre iPhone, pre Facebook, it was the first really breakthrough in financial impact, really successful financially, but also health impact. Helped tons of moms and babies it was either not worry or get into the ER now.
It absolutely. And it was again, to me, one of the great simple use cases of what remote patient monitoring was doing, what the impact of having simple, easy to use solutions to access, a mother and patient, somebody who weren't proximate to each other, near each other, to resolve a problem binarily.
Yeah.
Great. So, but it was a great solution. But the beauty of my life and timing was the iPhone came out that year, and Steve Jobs stood up on the worldwide development stage with the two founders of Airstrip standing behind him. the World of Development Conference #1, and he had the two of them standing, and he held the iPhone up, and he said, "Here's how we're changing healthcare. We're saving babies' lives." And they told us ahead of time, we're going to blow up your server, and they did.
Right.
But also they blew up the process that I was running through, and it was wonderful. All of us, I suddenly had GE, Philips, Qualcomm, Siemens, Intel.
We all need in this space.
All chasing this asset, and ultimately Sequoia and Kleiner chased the asset, and Sequoia ended up clearing the table, and it at a wonderful valuation from a banker's perspective. But we're going to go through, a very high valuation at the time, but they wanted to be at the forefront of this. So they learned a lot from it. But during that process, I essentially had GE, Philips, Siemens, Qualcomm selling my team and the Airstrip team on where and why they should be part of that franchise, because they gave us their playbook of where they were going in remote patient monitoring and where they were going.
And so you're helping Airstrip, but two, you're gathering this intel of what everyone's plans are at the point when healthcare went from trying to figure it out to now there's a platform, the iPhone, that can really enable this at scale.
Yeah, no question. That's exactly right. So I suddenly stepped back from that because I had seen into where all of those organizations, Qualcomm, Intel, GE, Philips, Siemens, were going over the next 10 years. I stepped back and I actually put up on my bio mHealth Banker. At that time, telehealth wasn't referred to as just mHealth. Yeah. So there was digital health at that time. I said, I'm going to be the first mHealth banker. And because I'd sort of closed this very sexily, highly
visible deal. You've done the best deal. Right.
Yes. And then and on my business and your business, deals beget deals. And I started to see a lot of transactions. And it was really where I started to recognize the need for research and content. I want to differentiate myself by publishing research, and we'll speak about that later in this discussion. Yeah. We've now published multiple white papers on the telehealth space, the digital space, and some of them become really some of the seminal work.
So I want to get to Ziegler and the research of it, but I just want to point out for the audience that this is why I wanted to have you on. The details of a transaction, right? And we'll talk about market pricing, and maybe we'll talk about sort of how many prospects you go, how you run a process to try to get everyone to the finish line at the same time. That's valuable. And in my opinion, every banker does it pretty well, right? Everyone has the data. Everyone has a login to PitchBook and can gather the information. But that industry knowledge of where it is today and where it's going and how all the big players providers, health systems, payers, the federal government, digital health, how all that's coming together and where it's going to go. That's what you can really create incredible value in. And the research is sort of part of that.
It is. So I created a sector map in my first white paper 8 years ago that started to sort of untangle the space into digestible bites. So it was a early paper that said, here's a lens to look at the digital health space in quantitative, because the value proposition, both reimbursement, stakeholders, and channel partners for urgent care, teledoc, solutions versus, a tele-ICU or tele-stroke versus nurse communications versus senior living versus behavioral health. They're in totally different use cases, totally different channel partners, totally different payers. So I tried to untangle it in a more digestible manner.
For you with your team and your partners, and then with your clients, defining what you mean by different terminology. This is what we mean by ICU, telehealth. This is what we mean by direct consumer, et cetera, advanced practice telehealth, with different categories. You might then debate where companies go, but that's where the magic is. Like that's where you really get the learning. Like, okay, the map's not the territory, right? The research paper is the tool we're using to try to understand this landscape. Yep. But debating over how to interpret this landscape, how do we map it? That's where the really insights come, I think.
That's right. And we'll talk about, and the first paper had 140 companies, and the last one, the fourth one we just published this year, had 832 companies. So it shows the breadth.
Okay. So let's talk about, I know you brought a couple slides. Let's talk about Ziegler, because Ziegler, you have a wealth of experience, but then Ziegler multiplies that. There's so much resources there. So
it does. And it's going to play off a very similar theme as to how I went from GE to Shannon Hammond. Ziegler to me is sort of a perfect conclusion of all of that career, because one of my partners that I was working with at the time at Raymond James knew my professor, Chris Rogers, called me up and says, Grant, you need to join. You need to come and see Ziegler.
You got to come. Right.
You need to come and see Ziegler. He said, your skill set and where you are. He said, Neil Borg has accumulated, some of the best sector experts in their areas, whether it's behavioral health, whether it is senior living, whether it is physician practice management, whether it's home and community services. We have, I'm a deep expert in the digital health and telehealth space in each one of those sectors. Neil
Chris is really good in behavioral health.
Chris Rogers is unquestionably the leader in the home in behavioral health and autism right now. Chris Hendrickson is on many association boards as well and is leading the home and community services and home health. Andy Colbert is one of the most prolific bankers I've ever seen in my life in the practice management space, whether it's radiology, anesthesiology, oncology, continuation, pathology. We're at the front edge of that. Neil Borg and Mark Turco are leading our revenue cycle and performance improvement practices. Patrick Walsh leads the efforts in lab and clinical trials and pharma services. Yeah. So we have a wonderful. But Chris called me and says, "This place is made for you." And it is a wonderful culture, and the best thing about it is there's zero sharp elbows. This is an organization that collaborates at the top end for all the deals to bring absolutely the best resources to bear for the clients. So, Chris brought me and I joined and I left and I could not be happier. But I think go to this.
It's not the biggest bank; it's the best bank. Right,
that's right.
And I don't think you or Dan or any of the leadership at Ziegler is trying to be. Can you see this now? So for the listeners, that we have about a third to 40% of the listeners are watching. But look, we need to talk through this too, because I have some people that are on a jog right now, or they're maybe driving in their car. So this is the Ziegler advantage, kind of at a high level, and talk through Ziegler, what you joined and what the company is.
Yeah. And so Ziegler is 100% healthcare investment bank. So, the beauty is that the firm is still privately owned. roots all the way back to 1902. So it is one of the longest tenured investment banks, 100% healthcare, that has been in its legacy, has been doing hospital and post-acute senior living, bond financing, and M&A for 100 years plus. Neil Borg created, and it has 190 professionals, over 60 managing directors, and 20 offices nationally, does M&A and capital markets work, and actually has a subset group that does some proprietary investing in early stage healthcare and senior living facilities.
So it's a healthcare banking expertise. Although it's not as big as some of the bulge bracket firms, 20 offices, 190 people, it's a significant institution.
I will tell you, in the middle and lower middle market banks, because again, we do everything in healthcare services, technology, and IT. So view us, we do everything but life sciences and devices, everything surrounding that. So in that sphere, I do think we're, if not the biggest, one of the biggest banks that does capital formation and M&A broadly in the healthcare services space.
Yeah. And then this one is sort of some of the transactions. Talk through this slide.
So again, when I joined the group, so Neil Borg started similar to sort of my entry into Shannon Hammond. Neil became the leader and solicited the group, saying, I want to create a corporate finance practice here inside of Ziegler that will begin to leverage this long 100-year legacy. So he brought the group of participants that I was referred to in to sort of form this practice. And we now have it just in the corporate finance M&A practice that does what I do. There's 45 professionals, 10 MDs that do some of what I think are the most impactful transactions across the healthcare services landscape, with some of the biggest brand name counterparties that you see around them, whether it's Philips or Mednax or UPMC and Centene's of the world, to some of the biggest brand name private equity and venture capital firms. We are doing 50 plus transactions a year in this space, and as you'll see in the next couple pages here, some of the most impactful deals in the space. So here are some deals. Yeah. So this is if you think about sort of what I described, I view it as we do some of the leading deals in the navigation and access in the space, a lot of deals in the telehealth and the remote patient monitoring space, tremendous amount of deals in the member engagement and patient access space, and most recently, the last several deals, Ziegler has done the market-changing transactions in the value-based care and population health space. So there's a whole series of deals that you see on this page that others can see afterward. But similar to my practice about disruption and innovation, we are at the tip of the spear of doing some of the more innovative deals in the space.
Yeah, and I think the categories are really the key I want to point out. There's a focus in really four areas that you're highlighting here, very active in all of them, right? So navigation and access, how do patients navigate the system? How do they get access? How is that taken care of? Telehealth, RPM, patient member engagement. I'm happy to see one of my portfolio companies there cared for that y'all helped. And then the value-based care. And these things all fit together, but there are differences too.
Absolutely.
So talk about your market presence. This is a good slide for people that are listening. On the left-hand side, as you look at it, it's all the different places where you are presenting, educating people, learning, 20, 30 different events. But more important to me is the deep dive research. So talk about this slide.
Yeah. So we are very active in all the leading associations. Certainly, Ziegler in the senior living space is the anchor tenant or sponsor to many of the large associations in the senior living space, and that we are also very active in a number of the what I would think sort of forward-leaning, most formative business. Obviously, the ATA is there. I've been lucky enough to be probably one of the earliest and only bankers that have gone to the Health Evolution Summit for, since its inception. I actually helped David Brailer raise his capital at Care Management Sciences. And I actually, similar to my time, my time with David gave me my PhD in terms of how content can be adjusted. And that is, to me,
that's probably the best conference and really highly curated. So being there for the year one is incredible.
It's been wonderful. It is, and I view it as sort of filling my buzzword bingo card out for the next 12 months of the year, because you feel and hear where's the puck going from because it's a C-suite only event typically, and so I've had the opportunity to go there.
And the speakers are good, but I always find the coffee. I mean, just with the quality of people that are there, the meetings that you have in a week, they're incredible.
Yeah, no question. And so we participate in all of them. We actually sponsor many of them. We're the lead sponsor of the ATA. We are now one of the lead sponsors of Health Evolution, across the board here. But part of the reason we've been asked to do that is Ziegler is, one of the most prolific participants in the space, certainly in investment banking, that produces targeted, focused, incredibly rich, deep research papers. Whether it is in the senior living space, the behavioral health space, the home and community-based services, the patient navigation, and my team has published 4 different white papers on deconstructing the telehealth space broadly. And so,
so I have it right here, and it's deep. I mean, it's I'm gonna look right now, 40 pages, and they're. There's a lot to them. And so I keep it as a reference. I mean, it's a great thing to read through, but then I'll want to dive in and look up something because I'll know the top 3 participants in a particular niche, but you'll go into the 10, 12.
Yeah. And so what I tell people, as we end this, I can, if somebody wants to see them, they can email me and I'll send them a digital copy or hard copy, because hard copy, as you just have, is easy to do because my brain works in placemats. So as you see that document, when you fold it open, I rarely can do things on a simplistic way without big placemats. So, this is a presentation of the 4 white papers that we have published over the last several years. The last one we just published, and actually at the ATA conference, in March, and it builds off of it. And interestingly,
So just for the audience that's listening and not looking at it, Ziegler does several different papers, research studies on different areas. This is, I think, the evolution of what we would call digital health today over time, starting in 2016 through 2023. And so you're on part 4 or version 4 of this process.
That's right. And back to what I said before, the paper, the wonderful timing just preceding the pandemic in January at JP Morgan, the year the pandemic came out, we published our 3rd white paper. And initially at that time, we highlighted where was the puck going, behavioral health, senior living, and decentralized clinical trials was sort of a thought topic, and all of those.
And then COVID accelerated all those things. So instead of happening in 5 years, happened in 5 months. Yeah.
That's exactly right. And then interestingly, we published this last paper, and I've been sort of even in the header of the paper in number 2 and 3, we sort of highlighted that we want telehealth to become just part of the fabric of healthcare. Telehealth will just be synonymous with healthcare. And I think we're there. And so when I speak to the ATA now, I talk about that, telehealth really is about 2 things. It's about creating unencumbered access to the most, for physical and behavioral health to most vulnerable populations, whether it's rural or urban. And it really is about workforce optimization. Now, how do we create tools and technologies to optimize the delivery of care to the right level of licensure? And those 2 ends of that spectrum almost captures everything today in telehealth and digital health. Is how do we create unencumbered access as seamlessly as possible, and how do we create tools and technologies that ensures that everybody's on top of the license, because we have such a huge workforce problem right now. And I think that really is what I try to sell is, where is telehealth going? It really is about those 2 core themes. And most of what we see in the industry today, in the market today, plays off of those 2 themes one way or another.
Yeah, definitely. So then within that paper, within that study, this is, I think, one of the best slides. It's an eye chart online, but it gives the entire universe of access to digital health.
Yeah, it absolutely does.
I might zoom in. So this is the starred box.
And I've used this page has been in all four of the documents that I continually highlight.
Yeah. And it keeps getting updated and sort of building out.
But it plays off of, again, the same things of, what are the characteristics of a successful program? Being disruptive without being disrupting. And it plays to where are the key elements, and really there's 5 factors that I use this as a scorecard for all the companies I work with. It is, what are the key elements? Is it easy to use and implement? Is it embedded within existing workflows? Does it provide analytically driven engagement? Does it filter out the noise? And does it provide timely, relevant feedback? Bingo, of course. But probably the most important thing of any attribute of these companies, do you have the ability to create a program champion within the organization you're going into? Whether it is a health system, whether it's a provider, whether it's a payer, it has to be easy. This has to be the easy button has to be there, because the problem with whether it was disease management, chronic care management, 10 to 15 years ago, was they were wonderful tools, but if they didn't work or they were difficult to use, they went in a closet or a drawer and they were never touched again. The beauty of where we are now in telehealth, to some degree, because of the pandemic, it's the ubiquitous of the devices and the ease of use of the devices within the infrastructure, and whether it is 5G or AI that has been the elixir to making that happen. We have a framework now where these tools, both the payers, the physicians, the patients, and family members, are all used to during the pandemic, used to and accepting and trusting. This is, to me, back to the old context of our value-based care and evidence-based medicine. This is all about trust. And I think we're finally at the point where people are beginning to truly trust that these solutions will be part of the fabric, and one of the only ways we can navigate the workforce shortages and the access to vulnerable populations.
Yeah. I think we all were forced from necessity to learn about using our phones, using Zoom, using telehealth tools in the pandemic, because there was no alternative.
There was no alternative.
That drove adoption in a way that nothing else could have driven adoption that quickly. It would have been impossible to. That crisis drove everyone get up the learning curve. Now the pandemic has ebbed out, and we can use that. Everyone has learned it. We can use that sort of understanding to deliver these things along the bottom here. Enhance patient, being able to self-manage, better care pathways based on evidence, and value-based care sort of delivered in this holistic fashion.
It
is
really
incredible.
And the beauty of sort of the practice of my team that works in Ziegler is this crosses over now just incredibly elegantly to the behavioral health space. There's no area in telehealth that is at the ATA, we used to say we want, telehealth and digital health to be as good as in person. The one area that's proving to maybe to be better than is in behavioral health. The behavioral health, and it will be, long term, the preponderance may be delivered virtually, to some degree because of the stigma sometimes associated with it, but mostly just to create compliance and access. 40% of all behavioral visits are canceled or missed if you can create a more easily accessible. But it also fits seamlessly over the home and community-based services, the hospital at home solution sector. It fits elegantly into the physician practice management space. So we're now at a point where these tools solutions are part of the broad fabric, and all we can bring to bear, because we're, as you saw, we're at the forefront of the innovative technologies and solutions, and they have to embrace these digital health solutions.
Yeah. Okay. So thanks for that. That gives a great perspective of everything that you are working through at Ziegler. I want to pivot now to talk about the markets today, because we all have to exist in the capital markets that we are living in. But before we get to that, let's just have a quick note from our sponsor, our sister fund, Jumpstart Foundry.
Thanks, guys, for the opportunity to talk about our pre-seed fund, Jumpstart Foundry. My name is Doug Edwards, CEO of Jumpstart Health Investors, the parent company of Jumpstart Foundry. We're so excited to be able to talk about early stage venture investing, certainly the need for us to change the crazy world of healthcare in the United States. We are spending 20% of our GDP, north of $4 trillion a year on healthcare with suboptimal outcomes. Jumpstart Foundry exists to help us find and identify and invest in innovative companies that are going to make a difference in healthcare in our country. Every year, Jumpstart Foundry invests a fund, raises a fund, and deploys that across 30, 40, 50 assets every year, allowing ease of access for our limited partners to invest to help us make something better in healthcare. Some of the benefits of Jumpstart Foundry is there's no management fees. We deploy all the capital that's raised every year in the fund. We find the best and brightest, typically around single-digit percentage of companies that apply for funding from Jumpstart, and we invest in the most incredible, robust, innovative solutions and founders in the United States. Over the last 9 years, Jumpstart Foundry has invested in nearly 200 early-stage, pre-seed stage companies in the country. Through those most innovative solutions that Jumpstart Foundry invests in, we also provide great returns and a great experience for our limited partners. We partner with AngelList to administer the fund, making that ease of access not only with low minimums, but the ease of investing in venture much better. We all know that healthcare is broken. Everyone deserves better. Come alongside us with Jumpstart Foundry, invest in making the future of healthcare better and make something better in healthcare. Thank you, guys. Now back to the show.
Okay, we're back. So, Grant, thanks for walking through that deep dive into Ziegler. I think the audience can see why I wanted to have you on. The wealth of knowledge around sort of how the market has evolved, how the technology enables it, how reimbursement can be standing there ready today, and how honestly incumbents and new players are kind of leaning in and adopting new technology along with the patients who I think have been ready for several years. That all has come together, almost a perfect storm where we are ready to change the way we deliver care, change the way we pay for care, change the way that patients interact, have risk be shared and the upside be shared. And yet the capital markets have shifted dramatically. And so I want to show you this this research I gathered out of PitchBook. So in the last we sort of had a really hot market after COVID. Everyone started using their stimmy checks to buy things. The supply chains weren't ready. Inflation went up. The market went up. Everything went kind of crazy. And there were 1,610 venture deals done in this sort of peak period. I just pulled out this list. You could pick any time frame. But in those 18 months, 1,600 companies were financed. And the management teams, of course, it's a bell-shaped distribution, right? But in general, they have executed, they have delivered on what they said they were going to do in that when they raised the money, and now all of these growth companies, these are early stage seed A, B kind of rounds of venture, 1,600, and total capital of $14 billion was put in place, and I believe that those companies now cannot raise money at the same valuations, the same terms that they raised money before. I think it's impossible. I know you have some slides to talk through it, but I want to just sort of discuss it first. The market has corrected. The public comps, where we all are going to have to eventually sell to a public company. Some of these companies might go public. You have to eventually connect to the public valuations. And I don't think it's going to be possible to raise capital at the same rate. But I want to get your thoughts on the market overall.
No, you're spot on. And to some degree, we're in a much healthier environment today than we were the last several years. It would have been wonderful to see a continuation of the level of capital flowing into the space.
Yeah, you and I both love it when the valuations are high and there's unlimited. Not
really. I will tell you, as I tell my wife all the time, I'm a marriage counselor. I manage expectations. I sort of bring parties together, and it's not really a healthy environment. When deals are overpriced or mispriced, it isn't healthy for anybody because it's difficult to build back into them. So where we were, 2 years ago is money was flowing in, and it was really chasing revenue and chasing growth at any cost. And revenue and growth was, money would pour in anybody that was showing revenue growth, capturing share, and had a viable solution. But discipline to valuation was lost. and I think where we are now is we've pulled back, and the market is shifting its lens really to much more prudent valuation metrics that are honestly much more in line with history. And also looking more at, and we're going to talk much more about this, about really a gross margin profile and a clear pathway to profitability. Because profitability was almost an ugly word 3 years ago, 2 years ago, 1 year ago, because it was all about growth and we can just pour money into companies and they'll eventually get profitable. Well, if you don't price deals and acquisition M&A correctly, you're never going to get there because you will always be dealing with a benchmark that you'll never be able to grow into in terms of valuation. And so we'll speak to that in more detail. And I actually view where we are now is an incredibly much healthier perspective. And I'll get into sort of how I think the market really thinks about valuations in terms of whether it is a staffing companies to a SaaS company. But we'll touch on that later.
Yeah, so I have the unique perspective personally of, besides hosting this podcast, I'm a VC, so I get paid. And I have two funds I'm managing right now. I have a fund from 2017 that's fully invested and participated in several of these 1,600 rounds and have portfolio companies that we have to navigate through this situation. And then I have a new fund that doesn't have any of that baggage, that has fresh capital. And I'll start with the new one first. We are seeing seed stage deals that are leveraging technology and AI in the cloud to be cash flow positive, break even, profitable growth right now, today. And my choice of investing in a fresh new company with no baggage, no things to figure out, versus jumping into a Series C round with all a very complicated board structure, preferences, people that are mad, a bunch of employees that are frustrated and burning money. My new fund's not going to do that. Right? So you have this really interesting dynamic where you have some new startups that are entering the playing field with a different frame of reference. But then you have 1,600 or so companies that are trying to unwind and navigate the way through this complexity. So I think that's what we are seeing out there.
No question. But back to your opening statement about one, we always have to, unfortunately, whether it's in real estate for your home or the market, you have to navigate yourself to where the public markets are. And if you pull up the slide, if you would, on sort of where we've, because this is a critical slide in my world of sort of managing expectations, because when you asked, where are we going in healthcare M&A and our deals getting done? It's taken a year.
I have been on boards where you have presented this slide. It's a great slide. So let's take a minute and walk through it.
Yeah. So fortunately or unfortunately, the market has come back to sort of historical norms of where valuations are. And again, I've always, to some degree, hated revenue multiples because it really is. It's an imperfect measure of a company's value. Companies should be long-term valued on sort of steady state EBITDA, steady state cash flow, profitability. But for earlier stage companies, we use metrics that aren't there. But this shows.
Yeah. Well, and I think the case for it is we're growing into this EBITDA over the next several years, but we're not there yet.
Yes.
And so some kind of growth rate can be used. But anyway, talk through the slide. So in November 21, you picked November 21 to sort of pick the
right. So for people that aren't looking, the slide shows that from the peak of the market, we're down 65% across the digital health and sector. All the relevant public companies that trade in, or that we are looking at in the digital health space, are down 65% on average from where they were in 21. But interestingly, those revenue multiples, that were in the 6+ times, are shifted down, but some of them are very different in terms of their characteristics, because interestingly, the gross margin profile of the companies over that horizon really hasn't changed much. There's still, the premise of where they were, the gross margin percentages were in the high 40s in 21. For the same set of companies, they're still in the high 40s, but they've started to navigate to more traditional levels of multiples of where they should be based upon the type of companies they are. When I think about pure staffing companies that are staff augmentation companies that are trading in the high 20s to 30% gross margins, those are staff augmentation companies, and they should be trading at staffing, augmented staffing multiples in the 1.5 to 2.5, but the companies that are really in the 80% to 90% gross margin profile should be trading at and can be trading at a 6+ times multiples of revenue, because really all that is revenue multiples should be looked at and thought about as a reflection of what steady state growth EBITDA could be because of the gross margin profile. So the world today has shifted their lens to saying we need to get back to traditional metrics of valuation, and traditional metrics of valuation really are gross margin and steady state EBITDA, not.
Yeah. So if let's take Teladoc and LifeStance, just to pick two out that I know well, and I think will illustrate the point. So Teladoc hasn't changed its gross margin materially, and LifeStance probably hasn't either. But LifeStance is growing much more quickly because behavioral health is a huge problem, and they are offering sort of in-network reimbursed for individuals behavioral health. Is that fair? So their EV to revenue multiple is slightly higher than the market. Teladoc's is slightly lower, pretty close to exactly on it. And that's probably proper, right? The market share has come down. The valuation has come down broadly across the whole thing. And then if you have really strong growth, even as a public company, you get a slight benefit to that.
That's exactly right. And so the concluding component of this slide really is the combination. Valuation should be a combination of two things: growth rate and profitability. Period. It's sort of a combination of those two things, and what the gross margin, and more importantly, what is the steady state EBITDA margin percentage and growth rate really defines. Whether you think about the rule of 40s, the rule of 50s, what growth rate and what EBITDA margin profile defines successful companies. If you think about the fit of how you should be valuing a company, it is those two things. I sell companies on a forward position of where revenue is going to be in the forward period, but it's only if I can justify that growth rate through existing platform growth. But more importantly, we focus on what is the steady state gross margin and EBITDA profile of the business when it's at a platform size that can be financeable or exitable. And you have to have more discipline, because the problem we have right now is where we're going to go in this discussion is we have an incredible cadre. In my white paper, I have 832 companies. 75% of those companies are sub 20 million revenue. A vast preponderance of those companies raised capital in the last couple of years at, unfortunately, valuations that they were too high, that they're going to have an incredibly difficult, if not impossible, time building back into. And that creates a really difficult conundrum for the sector right now, because they're trapped. Because to raise money is going to be difficult to take place, because they're going to get crushed. The valuations are going to be reset. So we're seeing more penal, whether it's participating referrers or pay to plays. There's structures that are essentially forcing the ills of the past to sort of come to bear, in which the stacks, the preferences, the nature of the structure are reset, so that the company can operate now in a reset environment, in a healthy environment where option pools are reset, motivations are reset, and access to capital is reset. And that's fortunate where we are today. But back to we're in a healthier place, and it's taken 12 months, unfortunately or fortunately, for management teams and boards to navigate these scenarios and come to realization. So we are starting to see capital come into the market, and we're starting to see M&A take place. And I know that's where you want to go as part of the next discussion.
Yeah, so let me try to see if you agree with this example, just to use as a place for people listening to get a handhold, because there's a lot of complexity. My kind of working to simplify it is, if you're running a high growth business and raised money 2 years ago, $10 million revenue business, the general market is at 6 times revenue, according to your slide, right? The public markets are. And so you raise money at the fair price of a $60 million valuation, right? And there's lots of moving parts. Like if you're more profitable or you're growing faster, but just to keep the math, it's easy for people to do it in their head. You have 10 million in revenue and the company's worth 60, you raise some money. And then the management team operates well. Let's say they double revenue to 20, which would be, it's pretty hard to grow from 10 to 20 in an 18-month period of time. But now the multiple has come down to 2. Right? So the management team has done everything that they were supposed to do in my made-up example. They've never made a mistake. They've doubled the business. It still has great prospects. Everyone's going full steam ahead. And yet the valuation multiples have come down to 2. So 20 times 2 is 40. So all of that work, all that effort, and you have lost value. You've gone from 60 to 40, and you're out of money because you were never financed to the finish line. These companies raise money for 18 to 24 months. And so it's time to raise money again. The team has done everything you asked them to do, and yet you can't raise money. And so what do you tell a board, or what should a board member or an investor or an executive think about in that scenario? Or is that scenario not fair?
No, it's very fair. But I think there's two sets of companies right now that we're navigating with. There's those that are where you are, or those that had raised capital, still are profitable, have gross margins that are in the 70s to 90%, and are still able to achieve outsized multiples and have expectations that are well aligned. But it's still, even their expectations were multiples in the 10 to 12 versus where the market for the services companies were. Yeah. But for the companies you're speaking to, it is, and we're seeing this over and over again in the space, because everyone is trying to figure out, certainly with some urgency, how do I find the next pathway to, one, recouping my equity or getting back into the growth pathway, and one, we're seeing what was growth at all costs, money flowing in, building infrastructure to chase revenue growth, much more focused on how do I find a clear pathway to profitability, because the market is to raise capital. You got to show me a way to get to cash flow positive. That's right. So it's got to be cash flow. We are now in an incredible, the dialogues you have in the marketplace. If you're not already profitable, when there's a number of companies that we're marketing now that are profitable, which is great, but they've just gotten there in the last couple of years. But if you are at that point where you're still burning some cash, you have to have a credible story today to show a pathway to profitability. And therefore, and if you create that with both a set of a pipeline and infrastructure, but more importantly, starting to think about your cost structure to get there. And so it's an interesting.
I'm going to be more aggressive. Not think about it. You have to cut costs. Yes. Period. If you are raising highly dilutive money, you have to cut through the meat. You have to cut a little bone. Management teams never cut enough. I think boards, what I want to talk to you about is boards have a couple of choices, right? They could cut expenses and not have to raise money at all. That's the best choice. They could cut the valuation, and it's really painful. Now I have to take a write down in my fund. I got to tell my investors, this company that I love, that I've been writing you about and telling you how great it is, we're now taking a write down on it. Even though you see Microsoft up to the moon with AI stuff. My really valuable asset is appropriately written down. That's not that fun. Or I can try to structure my way to a very complicated security with a 2x participating preferred and all this complexity, really to hide the fact that I'm writing it down, or I should write it down, but sort of make it so complicated that many people don't know, and I can pretend like I don't need to take a write down. Now, I may be over exaggerating it to make the point, but those are the options, right? Don't raise money at all and be cash flow positive right now by cutting costs. That's difficult. Take your medicine and recognize that, okay, our value has been cut in half or 60% lower, maybe lower than half, and do sort of a clean term sheet, but on a really bad headline number. I like that because it aligns incentives and it's not complicated, but it is apparent to my investors and everyone what the problem is.
Yep.
But then you're cleaning the forward. Or what many people do that I want your opinion on, you can tell my opinion, they add a ton of complexity and structure because they can, and they have lawyers and they structure it, but the misalignment of incentives is dramatic in that case. So what are you seeing out there?
Yeah. No, and again, two ends of the spectrum. You still have, and we're going to speak to the second story. You still have a fair amount of companies, and I've got a number of them under contract. I'm closing 3 deals in the next 4 weeks. And I just closed a deal that reflects this called, Somnoware and a sale to ResMed. We're wonderful, high growth, profitable companies that were getting rewarded for their discipline. You then have the other side of the spectrum.
If you're profitable and growing quickly, that's a different animal. Those companies always.
That's right. And so, but then we have the other side of the spectrum where I'm seeing a lot of, and we're actually very active in, is dealing with companies with the exact set of circumstances. Because honestly, many of them, if not most of them, really still have a strong value proposition, are still creating business, have great logos, have great market, but their capital structure is their biggest liability. And so finding and their board dynamics, their capital
and
structure,
they have done nothing wrong. I mean,
they've done nothing wrong.
No one's done anything.
That's right. Except for, that's why in our world, back to my time at GE, it's all about valuation. Mispriced, poorly acquired deals, poorly financed deals are the death of a company, because whether it was over-levering companies at GE, when I was with GE Capital's Corporate Finance Group, at higher valuations that cross those companies, whether it is what took place the last couple of years, prudent and disciplined valuation methodology and thoughtful structure and thinking through the entire life cycle is absolutely there. But where we are now with a large preponderance of the companies in the healthcare, in the digital health, and the technology space, is unfortunately mostly about capital structure and board dynamics and misaligned incentives, period. And so there's only a handful of ways you get around them. You've cited several of them. It is, cutting costs, finding a pathway to profitability, building out the use cases that can get there, and trying to reset the market and the valuation of the capital structure in a more disciplined way. And it's still, you still always have to create the right amount of incentive for management. So we are also seeing continually reset option pools, because you can't have success unless you're a motivated team. So, it's even more dilutive to the existing pool, because you have to reset the option pools.
Yeah.
So all those things lend themselves to, a very artful process. Our world is really about expectation management, managing processes, but really the marriage counseling of dealing with all of those constituents to get to the right level and the right appropriate structure. So whether it is, finding, debt capital, because there still is, venture debt that people are using. Now, what took place with Silicon Valley Bank, did create a blip in some of the pathways that many companies are using to get to a structure that was an elixir to avoiding this problem. But we're now in a place where the one piece of the puzzle that you haven't added, I think, is one of the areas we want to talk about that we're seeing a lot of, is mergers of equals. Again, scale.
Yeah, so you taught me about this last week. I don't know this space, but it's really interesting because of all the companies, whether it's 1,600 or 1,000. There's a lot of companies in this space that they need to figure out something.
Yep, but they have to think of. But at the end of it, if you go back to some of the core tenets, scale matters. the only way that the sector and companies are going to become, to where they get to profitability and leverage their gross margin and their SG&A, scale matters to them. And there's too many point solutions. There's too many companies that are sub 20 million that have really good solutions, but they're trapped because of what we've just discussed.
Yeah, the buyers want fewer vendors. You get scale. You sort of get operating leverage. That is a really interesting approach.
I want to get to I really get the punchline of MOEs, because it really does it solves much of what we're discussing here. So mergers of equals, if you get parties that it has to be 1 + 1 truly does equal 3. That there really is a strategic rationale, and there is operating synergies, there are SG&A synergies, and there's revenue upsell. But the beauty of it is the headline number of valuation goes away. It's a question of
relative. It's a relative
valuation, and you can parties like ourselves and with those boards, they can sit and look at the traditional metrics that we just described: gross margin, cash flow, growth rate, and marketplace and logos and brand, and say, what is the prudent relative valuation between the two of us? Bring them together, and actually you solve a number of things. You shorten the pathway to profitability, you get scale, and you start to build a business that, one, can be financeable, but in the same breath, you also force the reset of the capital structure. So preferences and stacks get sort of rethought through the obstacle, and you kick the can on what is the real headline valuation until you build back into what you want to go. So I think it is one of the cleaner and most prudent ways for parties to start to think about, how do we get out of this trap for the groups that we're talking about here that don't have access to capital without crushing the existing stack. It's a means to start to do it. Now, they're complicated. Obviously, leadership and board and governance is the most complicated thing, but because there really are few alternatives, it is going to be one of the areas that I'm starting to see, because I have a number of them under contract right now. We're going to see a lot of growth of that taking place in the next couple of years, because
and I think Ziegler almost could. You could almost create a product, or there's a lot of companies that need this type of solution, and then you're very well positioned. I mean, this book, but you have a lot of other data that isn't published. You can help a company, a CEO and a board. Okay, who should we partner with? Who would be complementary? That can be part of the value that Ziegler offers. Is we want to find our merger of equals. How do we do that? How do we go about that?
Well, it comes back to trust. I mean, ultimately, for somebody like myself or a constituent to do this, there has to be a level of trust that does this make sense? It's approaching both the boards, posting the equity fund, and saying, here's why this combination brings together a series of services, solutions, and 1 + 1 does equal 3+. And the beauty and the unfortunateness of the last couple of years is it's taken a year for companies and management teams to finally come to grips with the fact that the market, those valuations aren't coming back. So we're at a point now, and I had more business done in 21 than I've done in my entire career. 22 was difficult because we had this transition in valuation. And now we're in a period where I've got 11 deals under contract. I've got 4 deals closing in the next month. And they're all reset to prudent, realistic, historic norms of expectations. And we're also looking at this mergers of equals. And it takes the lens of having somebody that says, here's why this makes sense, and here's why these valuations are the right size for these companies at this stage.
Yeah, what's interesting is there are benefits and incentive to being on the earlier side of this. Right? So there's 800 companies in your report. There's 1,600 that I was looking at. If you one of the first few that goes with Ziegler does a merger of equals, now you have double the revenue. You can cross-sell to your different customers, and you begin build. You don't have this overhang of every employee and every shareholder worried about valuation. Now you have you reset, and you start going and winning business and winning in the market. And then there's going to be failures. There's going to be assets that don't navigate through this, and you can now pick up their customers and just take their customers or maybe you acquire something for pennies on the dollar. The first kind of tranche of companies working with Ziegler, like this summer and fall, are going to be dominating.
You're exposing my current business plan, because the space we're talking about here right now is in desperate need of a handful of players of scale that are the platforms. You have Epic, Cerner, and Athena, Medic on one area. In imaging, you have a whole big series of islands.
Right.
So this space needs a couple players for high acuity, a couple players that do the post-acute senior living space, a couple of players that are dominant in the behavioral health space, a couple of players that are dominant in the access and navigation space. We're starting to build some of those, but what I'm looking at right now, and I'm talking to a couple people, is let's create, because with the landscape we are now, with the valuations that are now, with the realization that these companies are trapped, it's the right moment in time to find plum assets and bring them together on a platform to create that player of scale.
And there's an ocean of dry capital waiting for the market to find its footing. It's not clear what the Fed's doing. I think they're still raising rates. I think we're going to have a significant correction. We went over last show how top heavy the NASDAQ and S&P are. There's only a few names like propping up the headline numbers. But once you get the market chaos figured out, maybe it's 6, maybe it's 12 months, but it will come through. And then these mergers of equals have happened. You start to have another crop of future dominant companies. There's going to be like the next $10, $20 trillion, multi-billion dollar assets that are created.
Oh no, there are some of the largest PE firms in the country, to some degree, are sort of waiting for, and we've been discussing with, that sequence of events that needs to create these players, because there is an enormous amount of capital, and it's in the venture space of players that want to take advantage of everything we've been discussing, deploy capital to create this first stage of this capital formation. But right on the tail, and this I'm talking 24 and 25, there's going to be the big PE players dropping $500 million to $1 billion to fund the simulation of these players.
A big platform that is sort of pulling in 15, 20, 30 different kind of apps and product lines into a health system offering. And that could be really fun to sort of see come together.
Once again, you're giving away my business plan, but that's exactly what we're working on, Ron. As long as part of doing all the day-to-day work we're doing, we are actually creating and looking towards building that framework you just described. And it comes down to why we do the research, why Ziegler and the rest of my partners have such deep access is we know where the puck is going, and we have a really good finger on the pulse of who are the leaders in the space and who could be and should be part of this initial formation, and then who could easily be the parties that are tucked in to create that framework. So it's a good lens, but the good news is it's going to help resolve all the things we started with. How do we create, the health system, the payers don't want 25 points of light coming at them. They want a platform to deliver it, and it creates unencumbered access. But most importantly, everything we're working towards in most of the deals I'm working on is creating a workforce optimization tool, because we have an impending bomb.
There aren't enough people. There's just not enough people. Yeah,
there's not. We have a bomb about to blow up, and not just because of where we are today. In all honesty, the bolus of boomers that are coming into the healthcare system that are unfortunately the most unhealthy population in history, because they're the McDonald's generation, they're the smoking generation, and they have multiple comorbidities.
Yeah, they're all turning 75, 80.
They're going to be consuming healthcare like no other time. And we have nurses and physicians leaving in droves. So these digital health tools are the only way we're going to create access, because we have to use AI. We have to use all aspects of technology to triage this as efficiently possible, so that what has historically been a 30 to 40 minute interaction with a patient is done in 20, but honestly done in 20 better because they have all of the content, all of the evidence, all of the alerts, reminders, and all of the tools.
They have my data tracking every day over the last 90 days.
Yeah.
And it's been assessed. And so when they come in, it's a really effective 20 minutes.
It's right.
So I mean, for anyone in the audience, whether you're an entrepreneur or a institutional investor, or you're running a health system or at a payer or something in between, this is encompassing of the whole thing. We're redoing the entire industry in the next 3 to 5 years. And so it's great for you to set the table now. We have this on recording on July 20th. We're recording this. It'll be published in the next couple of days. It'll be really fun to come back next quarter, 6 months from now, and see it beginning to take shape.
I want you to put your lens in 24 and 25. It is one that we're starting to get and identify players sort of on what I would describe on the good side of the bell curve are seeing good exits, are seeing be rewarded for the discipline and growth. And then we have some of those participants are going to be the consolidators and building out and accumulators and attach themselves because there is so much dry powder out there waiting for what we're describing to get done.
Yeah. I think in 6 months, you'll be able to come back and say, okay, here are the 7, 8, 5, 10 mergers of equals. And here's the success they're having. They're starting to bring their teams together. They're starting to really win in the marketplace. Yes, the big change, like in the front page of the Wall Street Journal, won't be till 2025. But you and I and the Health Further audience will start seeing the formation of these things early on.
There's no question. No question.
Grant, just as we close, how do you keep up with all of these things? How do you keep up with the massive changes? Are there things that you're reading, things that the audience should follow to keep up with all the changes?
Yeah, I will tell you where I go to, again, we went back to all that list of conferences. I will tell you there's a subset of conferences, some of them are just vendor shows, but honestly, a number of them, whether it's Health Evolution, whether it's Vive and Health, and honestly, the ATA, the American Telemed Association, there is incredibly deep content and access. They've changed themselves to become resources for, identifying pain points, identifying resource. And honestly, so I attend a lot of conferences. There's a couple of them I actually sit in sessions. Most conferences people just go to do meetings. But you are seeing the continued assimilation. I actually sit on a lot of panels. I'm probably on, anywhere from 8 to 10 panels or keynotes a year. But you're seeing leaders in the space that you get to hear where things are going. And if you think and honestly, right now, sort of the Wild West is now in Chat GPT and AI and what's going on there. Yeah. And because that is going to be, the next evolution of how do we create guardrails to navigate, manage this into everything we've just been talking about. So we have not seen the first airstrip use case in AI yet, but it's going to appear in the next 24 months. Yeah. It's absolutely coming, and we're at the front edge of that right now. And I think I attach myself to players that whether it is Dr. David Rue at who's at Microsoft, he's somebody I've trusted for 20 years. I look to who are the leaders and innovators at each and one of these points. So I have good news is I have wonderful historical relation, whether it's in law firms, at the leading law firms, and certainly at these conferences, industry participants. But we all the great thing about life today is every morning I have 10 different articles, websites that pound on me. Here are the things, and I can very quickly navigate to the ones I want to see. So if you're going to be, the reason I've told people my entire career I'm not in life sciences is, you can't dabble in life science. You have to have a PhD. You have to have somebody sitting next to you. You have to live it and breathe it day to day all the time. If you want to do tech,
that's why I don't do it too.
That's right. If you want to do what we do for a living, you have to live and breathe it every day and be at the front edge of the spear of where innovation's going, where disruption's coming. And so the bankers and the institutions, and why Ziegler I think is so unique, is every one of the participants that leads our practice groups. And Dan Herman, who heads the firm, is sort of the ethos of this. He knows everybody and everything that's going on in the post-acute senior living space. Dan is one of the most unique go-to resources in what's happening in post-acute and senior living. And then each one of the participants inside of the corporate finance group that we have are similar to myself in the digital health and telehealth space, our go-to resources that the country looks to, and we all speak on panels. That's how we keep ourselves informed. Is we are constantly in the flow, but we stay in our lanes. You can't dabble and do a device company, or you can't dabble and do life sciences. You have to live and breathe where you are, and you become a resource in those spaces.
I think virtual care, telehealth, health virtually everywhere is your tagline. That's a pretty good segment to be in right now. It's where the puck is going, where a lot of things are going to be.
It's, whether it's lucky to be good, but again, it goes back to my father. I've essentially replicated my father's practice, my father's meaning, by saying, Dad, I was always admired. My friends always spoke to me about that. He used to stop and do house calls until he was 72. He practiced till he was 72, and he was still doing house calls until he was 72. And he was one of the preeminent physicians. I said, Dad, I've effectively recreated you, but I've done it, instead of 1-to-1, I've done you 1-to-50.
Right. Yeah. Excellent. Well, Grant, thanks for doing this. We need to have you back as we just follow this progression over time. Really appreciate it. Excellent.
Absolutely.
And I will put in the show notes. So in the show notes, we'll put links to your report, a couple of these conferences that you recommend, your email, LinkedIn. We'll give everyone sort of all the resources there so they can reference. They need to get your advice as they're thinking about their merger of equal.
Fantastic. And I really appreciate this. This was a lot of fun.
Yeah, this was fun.